Hello again and welcome back to the RegalX Trading Academy video courses. My name is Daniel Garcia and I'm your instructor on this video course series. In this course, number 1 of the advanced video series, we will talk about leverage and margin. You will learn what leverage is and what margin is and how to calculate the margin. You will also learn how to avoid trading mistakes due to margin. Now let's start with what leverage is. So basically, when you trade a position, you are trading a certain amount of money on the market. For example, what we've learned in earlier sessions, if I trade a position size of one lot in euro dollar, it means I'm effectively trading 100,000 euros against the US dollar. Now, if you look at my account size is 83,000 euros. Now I'm able to trade these two 100 positions. So I'm trading 200,000 euros on an account at a smaller than a 100,000 euro. And how is that possible? It is possible by what is called leverage. Leverage allows me to trade more money in my trading account than what I have deposited with the old account. And that is what is called margin. I need to put margin up to receive the ability to use leverage. Now, there is, in this case, for example, you can see here my account balance is 83,000. My open positions right now set me back by 930 euros. So my equity balance is plus minus my open positions is 82,400. The margin required to trade these two trades. Maybe I'll put it up a little bit and you see it a little bit. To trade 200,000 euros is 400 euros because we have the ability to use leverage here. High leverage actually, and this leverage has been or is the topic of the new ESMA regulations. So it's very important to understand what it means. This margin number will be a lot higher in a few weeks simply because the regulator wants to put a lid on margin, or in terms of how much margin needs to be put in order to use leverage. They are effectively reducing the ability to leverage. So again, in order to trade 200,000 on the market, all I need is to have 400 in the account. So it's like a multiple times of that number depending on the leverage set. For example, we can see in this account, if we hover over it, I have a 500 to 1. Now if you calculate 500 times 400, and we can do that for a moment here, so you can see, you can have a look as well. One second. I'll pull up to calculate again. 5,000 times 400. What do you think the result is? It is 200,000. So you can see that this is the amount of money. This is the margin I need to put up in order to be able to trade these positions. And then it shows me the free margin. Free margin means how much do I have left and money in the account to add more positions. In this case, it's basically the equity minus the margin. 82,400 minus 400 is 82,000. You know, just like these four, I remove them. So very, very simple. And then there is something called margin level. The margin level shows you your free margin in terms of a percentage number. And I will show you in a moment why this is relevant. So in this case, for example, my margin level is a very, very big. It's 20,600, which means I'm far, far, far away from running into any trouble with these position sizes. Now, to understand again, if my account size is 100,000 and my trade size and total are 200,000, that would mean I'm running a trade leverage of 2 to 1 because my position sizes are twice as big as 200,000 as my account size, which would be 100,000. Now let's get this here for one moment. Now, how do you calculate the margin? So for one, the number of contracts multiplied by the position size multiplied by the price. Obviously, because if euro dollar is at 1, it's different than it will be if it was at 130, 140, 150 divided by the leverage. That is your margin. So a standard contract one lot corresponds to a position size of 100,000 units. So if we trade 1 euro dollar, it's 100,000 units. 100,000 euro against the US dollar. The level of leverage depends on our account type. If in the example, leverage of 100 is used, so the number of standard contracts multiplied by 100,000 and the current exchange rate divided by your leverage gives the required margin that you need to put up. The MT4 does that automatically for you, but you should get an idea what it means. So if you want to open one standard contract again, 100,000 with the leverage of 100 with the currency pair euro dollar, what do you need? Your margin requirement will look like this. We trade one contract at 100,000 at a price of 10975. That's the example here, divided by 100. So you need to put up $1,097.50 as margin to trade 100,000 position on euro dollar or one lot. So that's not so complicated. A higher leverage, meaning if we have 200 to 1, for example, or 500 to 1, as in this example, it will decrease your requirement of margin. Here we needed 1,100 to put at a 100 to 1 leverage. Now it's very simple. If we say we have 500 to 1 leverage now, which is 5 times this number, we only need to put it up 1/5 of the size, and that's it. 219 is 1/5 of 1,097. And now think about it. If ESMA now comes and says we're reducing this 100 or even 500 up here to 10, then you will need 10 times as much money. You will need $10,000 to trade a 100,000 position on a market. So that's why it will become more capital needy to trade the positions the way they have been tradable up until now. Now, commodities and stocks, they have a little bit of a different margin requirement because the underlying value per one lot is different. For example, gold, one lot has 100 troy ounces. 100 troy ounces have a different value than 100,000 euro, or in stocks, for example. The number of contracts that are underlying of one lot, they are different. And you can see the exact margins on our website over in here. And then you can see what you really need in terms of margin requirement for different assets. For example, indices, you see, you need 1%, or equities is even 10%. This is shares. If you want to trade a sea of these or cryptos, even more, margin requirement is 20%. So you have a 5 to 1 leverage. That's what it means. So you can see that on this table for the Forex asset list, you can get all the ideas of how much margin you need to put up to trade a certain position size. Now, the big mistakes in margin are over leveraging. Now, people, they open up an account with, say, 100 euro or 500 euro. So 500 euro, and they open up a position of one lot because they don't necessarily understand what a one lot euro dollar means. That's the biggest mistake that people do in trading due to margin. They think, okay, one sounds small, it's not so much, but one actually corresponds to 100,000. So if my account is only 500 euro large and I'm trading a 100,000 position on a market, it means my position size 200 times as large as my account size. This is a massive, massive, massive leverage. Each tick up and down is very likely to kill or double my account even, So it's extremely risky. You should figure out what kind of risk do I want to take per trade in terms of leverage. Let's just say a normal sizing in FX would be to trade maybe 1 to 1, maybe 2 to 1. So again, if my account is 100,000, I can trade 2 lots. 2 lots will equal 200,000 euro, which will be twice as large as my deposit, 100,000, which makes it a 2 to 1 leverage. But you should very much, before you do any one trade, think about what the leverage that I'm taking. How much bigger is the position size I'm trading in comparison to my account size? And then we will go to that a little bit deeper in further sessions. You start to understand how much does 1 pip actually cost me? What is the value of 1 pip? 1 pip, the second from the right here depends on which pair you look at. But it's a very, very simple, small change in the pricing. And you need to understand sometimes if you are over leveraged, each pip can cost you the size of your account almost. So chances that you crash and burn are very, very high, especially if spreads start to go wide, and even consider that spreads are also pips. So it means that if you have a higher leverage, you also have a higher spread cost in absolute terms. So the dollar or the euro amount that the spread is going to set you back when you open a position will be a lot larger compared to your account size with the higher leverage position on the market. So really, yourself out to maybe use 1-to-1 leverage, half to 1 leverage, 2-to-1 leverage, but you shouldn't do 10-to-1 leverage, 20, 30, 40, 50, or 100-to-1 per trade, because that will very quickly lead you to something destructive. That's what we've seen many times over, and those are the most common mistakes in margin. So try to understand that margin is money you need to put in order to trade the larger position sizes than what your account size is. In order to receive leverage to do that, you put up the margin. How the margin is calculated, you can find out on our website using these and calculating how it's done. It's very simple, and once again, a position, the MT4 shows you here how much margin you need to put for that position, and you make sure you can watch your free margin that it doesn't reach low level. If your free margin call level reaches 50%, you'll receive a notification that your position is in danger of being closed. And if it further goes down to 20%, the position will automatically be closed. So that's how the mechanics in the margin trading work. In the next course, we will talk about the chart types and the interplay of different time frames. And I hope to see you there. Bye.